Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Chicago Soybean Complex. I'll start with Chicago soybeans themselves. Definitely no more beans in the teens. No more. The key reversal down on Thursday 2 weeks ago put pay to that. The move below 13 even, which had been mulled over for quite some time, had reached the conclusion, and it was to go ahead and lower. The most recent reason for this was Friday last week's shooting star pattern, type 1 bearish, which had an immediate follow-on lower from the start of this week until yesterday, when the market created an indecisive spinning top. Now the move down took out the important support of the big 50% Fibonacci line of the April 2020 to May 2021 move at 1243. Though, as I've already mentioned, we have had an indecisive spinning top yesterday. I have a suspicion that part of the reason we had this indecisive pattern is that prices may be approaching a nascent lower bear channel line, currently 1186 from mid-August. This proposed bear channel is still young, so don't get too attached to it. Not yet anyway. The majority reason, I suspect, for this action is that we have reached target X1 on the downside yesterday, and we're not far now from target X2. I will go into these points now. Let's look again at what the larger picture shows. I said 10 weeks ago here how I'd noticed two new possible patterns, not necessarily complementary. The first was a mid-June to mid-August ascending triangle. The flat topside trend line was capped by the resistance at 1459, whilst the broken rising mid-June today uptrend, currently at 1431, is the lower trend line. By late August, the market broke down through both the long moving average, currently at 1389, and the lower trend line. It is at this point that I'd like to mention once again the second related pattern. This is the bearish halfway hesitation that takes the action from early to mid-June, making the left flagpole. Now, the market has in reality made not just a bit of a mess, but a real messy mess of the right-hand side flagpole for this pattern. In part, a large part I believe, this has been due to the clash with the previously mentioned ascending triangle pattern. Nevertheless, prices had moved lower, down through the lows of June and back in late August, reaching the old target X once again in the 1290 area. This was the original primary target for the ascending triangle, and this is where we've been held until late 2 weeks ago. So what was to be next? Well, it seemed reasonable to look on the downside, and such below we've had for many weeks now two potential key targets. Target X1 was the secondary target for the ascending triangle in the 1202 area. This was, as I said, already achieved yesterday. And target X2 is the first possible ragged bear flag target in the 1178 area. And the problem had been that in between where the market had traded in September and the targets X1 and X2, we had two key 50% Fibonacci supports. Now, one I've already mentioned, for the April 2020 to May 2021 move at 1243. The other slightly lower one was for the 2019 to May 2021 move at 1229. Now these 50% Fibonacci lines are quite new, only finalized back in May this year, but they are still there. What has changed recently is that instead of supports, they are now resistances. Additionally, I'd previously pointed out that under these 50% Fibonacci lines, there would be limited support until the 1140s. Okay, so I would normally leave it there, except I had back in early September a short and very interesting conversation with Andre Sheckman in Brazil, a good friend of mine, also a technical analyst. He asked me to look at the whole of 2021 as a possible head and shoulders top. That's a big ask. But it is an important but. But what he asked does indeed have merit. I pondered upon this for a few weeks, especially as the action does not have as clear a neckline as I would like. But I can say this. The hesitating may be over, and this market may have now started a long trek lower. Thus I've drawn a neckline of sorts, and don't be worried, it could actually go back up to this neckline. The neckline's currently at 1261 for the optimized February to October action. And I have a couple of additional potential targets now below. Target X3, the preliminary target for such a head and shoulders top, would be in the 1083 area. A secondary target X4 would be in the 904 area off the bottom of my chart at the moment. As you'd expect, the secondary target would be harder to achieve. Indeed, the nearer target X3 is quite an ask already. However, that is what it looks like right now. Chicago soybean meal. I wrote some 14 weeks ago now, and I quote, "The month of May was a monthly key reversal down. It is important to remember that," end of quote. Now, what I wanted to emphasize back then and every time since, including now, is that everything since May has been in the shadow of that singularly bearish pattern. With this in mind, it brings into perspective the breakdown in June from through the long moving average, currently 387.70, and the further drop down to the lower time, currently at 285.10 of the bearish 2021 Andrews pitchfork. The subsequent bounce up in early July only ended in the market going sideways through July and August, and also running along the underside of the middle time, currently at 331.5. As part of this action, market action also created a lower trend line, currently at 344.5, and thus market drew a descending triangle pattern over July and August. In late August, prices punched down through the lower trend line of the descending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag seen during May and June. However, when prices dropped down there 4 weeks ago, the market must have felt that it was also too far away from the comfort of the middle time, and prices moved back up towards it. This is something I'd like you to remember, as it may be coming up again soon. Anyway, Thursday 2 weeks ago, prices finally took the plunge lower and punched down through the middle time, currently also target X and the low of early September at 332.5, and now made new lows and low closes not seen since September of last year. On Monday last week, prices finally reached down to target X1, the initial target for the descending triangle pattern, in the 326.10 area. Then yesterday the market made a new recent low and grazed the area around the secondary target X2 in the 306.80 area for this same descending triangle. I have in the past pointed out the caveat, and I do so now again, that secondary targets are far harder to achieve than the initial ones. As a final point, I would like again to recognize the wonderful job the bearish Andrews pitchfork for 2021, originally drawn back in May, has done in its task of channeling the market lower. It has been useful and valid up until this very day, and seems likely to be so for some time forward. That is the key to the market here, the bearish Andrews pitchfork. When it finally gets busted or adjusted to a bearish shift pitchfork or some other pattern, only then we can look for new ideas. But until then, the bearish incentive is still run and ruled in this market by this same simple bearish Andrews pitchfork. Chicago soybean oil. For months now, I have highlighted the rather lopsided diamond pattern seen over May to July. Looking again today, I still find it to be the one key pattern here, but it has some other competing patterns now. A few words first on this diamond pattern. Diamond patterns can be tops, bottoms, or continuations. In this particular case, it is a top. Back in late July, the market broke down through the lower trend line, but did not immediately follow through lower. Instead, the market chose to run along the underside of the broken trend line until it reached the right-hand side apex of the diamond at the end of July, thus providing additional bearish pressure to the diamond pattern's breakdown and making it a genuine action. Anyway, prices dropped in late July and early August, but were halted by the medium moving average, currently 61.29. By the middle of August, prices had overcome this obstacle and continued their journey lower through the congestion zone between 57.64 and 59.44, which you can see is a striped band across the middle of the daily chart, and punching through the lower trend line, currently 53.08, of the July to date descending wedge pattern. The market tried exploiting the breach, but all that was managed was an additional, if short, bear channel over mid-August to late September. 3 weeks ago, the market met a pair of obstacles on their way down which they couldn't overcome. They were the rising long moving average, currently at 56.56, and the 50% Fibonacci line for the whole of 2021 so far at 55.43. Now, prices managed 2 consecutive closes below the 50% Fibonacci line, but only just on the second day. But there were no closes below the long moving average, despite 2 days of breaching. As a disappointing consequence, prices moved back up again from the new small bear channel, as well as the descending wedge pattern, and most recently over the previously mentioned congestion zone between 57.64 and 59.44. Now, in this last process, the market has now punched up and out of the descending wedge pattern, as well as over the declining short medium moving average, currently 59.47, and even over the slowly declining medium moving average, currently 61.29. However, though the move up over the medium moving average saw 2 consecutive closes over, it was seemingly not enough, as prices have dipped below this week, as well as the short medium moving average, but have found it tougher going to try and penetrate the previously striped band of resistance that is now support between 57.64 and 59.44. Nevertheless, topside we have a potential target X2 in the 66.80 area for the recent descending wedge pattern. Now, I know this is a big ask, especially in the current circumstances, but I did add this last week when I laid it out, and I quote, "But unless this is a false break on the upside, that is what a potential target would be on the upside." End of quote. Anyway, I'm prepared for such an eventuality as last week. I also gave the following as an alternate to this new concept, and I quote again. 2 targets below for the diamond pattern. The initial target X in the 55.90 area has been achieved. We still have a secondary target X1 in the 53.80 area. As you're no doubt aware, secondary targets are much harder to achieve, so I'm not holding my breath over achieving target X1 below, especially as the gently rising long moving averages apparently put pay to ideas of heading lower. To be honest, achieving primary target X on its own was a big win, and going the extra bit to reach target X1 is not essential, and that's the end of the quote. I say that was quite an alternate, but I'd now like to introduce yet another new idea on top of all this. It is a mid-July last week high, well, mid-July to last week high basically, a bearish Andrews pitchfork. Currently the upper time is at 62.37. The middle time lines up nicely with the broken upper descending wedge trend line and the gently rising long moving average. That's currently at 56.73. And the lower time is down at 51.09. This is at best a speculative drawing of a pitchfork, and I'm happy to retire if it goes wrong. But I am very interested in how the middle time lines up with some of the other patterns in action, so we shall see, I guess. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.